we are going to take a look at part 3 of this case study, which has to do with using the money. So once you've got a whole life insurance policy set up for maximum cash value, often the next thing we want to do with it is use the money. Just like we would use our money in another account, we want to use it in the whole life insurance policy, building it up for maximum cash value. That's a lot of fun. It's one of the things I enjoy talking about and doing more than anything else. But the loans are very, very important. So when it comes to actually using the money, we're going to go through how it works, and we will continue to build on the case study we've examined in the past several videos. So what we're going to look at is the husband's and wife's policy values combined. So we've got a policy for the husband with Guardian and for the wife with MassMutual. Now we looked at a number of options. So just to summarize the options we're going to look at from what we put together for the couple. For the husband, we've got the L95 product. Specifically, what we'll look at is an option with the 5% PUA fee, which gives them more cash value up front and also more cash value short-term and long-term on a guaranteed basis. Where the potential drawback is of that lower PUA fee is the long-term performance on the non-guaranteed side of the illustration. So weighing everything, we decided to go with the 5% PUA fee, mainly for the higher upfront cash value and then the stronger guaranteed values on a long-term basis. And we are just going to look at the dividend illustration. We won't look at the indexed rider in this particular loan analysis. For the wife, we looked at the higher cash value and the 15-pay product. We're going to look at the 15-pay policy, mainly because of the lower PUA fees and stronger internal rate of return on cash value. Remember what their goals were? They were interested in cash value, wanted to maximize it, and then step 2 was to use it for real estate. So let's look at using it for real estate. What we will look at first are the combined values. So the funding scenarios we have here is for the husband, the option of $125,000 going in the first year, and then $100,000 per year through year 10. Now, quick item I want to mention here. If this is you, if you say, okay, Steve, this is the option I want to go with. I love how the cash value looks. I like the guarantees. I want to be able to slug away a little more than $1 million into this product. What if life happens though? What if I'm 4 years into it and I cannot pay $100,000 per year and that was my original plan? Am I in trouble if I cannot? No, not at all. This policy design, you may recall this, his premium, what he's committed to each year, is $10,000. And then he has the ability to add more money on top of it as the years pass. It's similar for the wife. The commitment is a little bit higher with the base premium and term rider. It's closer to $15,000 with everything combined, a little bit less than that, but similar where we are committed to the minimum amount with the ability to add more money into the policy. Here for the wife, we've got the initial lump sum, $125,000. Remember their goal was to move money they had in their bank accounts, $250,000 total, and split it between the two of them, $125,000 each. Now she can pay $100,000 per year into her MassMutual product, but because we've already got $100,000 per year going into the husband's, what we looked at here was just $50,000 per year going into the wife's policy, but instead of 10 years, going for 15 years. And she could end up paying in more, or also she could end up paying in less, but we've got 2 different funding scenarios here of all the ones we reviewed in the past couple videos. So what we've got, break-even point between years 3 and 4 with the husband. For the wife's policy, between years 4 and 5. What does that look like though if we combine everything? Well, let's combine everything. Fairly simple to do. What we've got here are the combined values. So you see a break-even point of year 4. When we look at that, total payments between both policies is what? $700,000. And the total cash value is just about $701,000. Now, I will add that these are both based on regular preferred ratings, which is the second best health class, and the current dividend rates. So by year 4, things could be a bit different if they receive a better or health rating than what we illustrated. Also, if the dividend rate adjusts, if they fund differently than what we've got illustrated here. My point is, illustrations rarely predict what will actually happen. The actual cash value often differs from what is illustrated. But while we look at this is what we're going to use for the loan model when we look at it. Here's the important piece to look at when we are reviewing loans. So important here, and often it is overlooked. People often start to look at this after the fact and almost have that moment where they say, oh, that would have been useful information before I looked at using a loan with this policy. Here's exactly what it is. So we've got the cash value, also the death benefit, and these are combined values. But here's the annual internal rate of return. What this represents is the net growth rate on a yearly basis. So for example, if I'm having a conversation with someone who has an existing policy and they ask me, what did I earn last year? What was the growth rate last year? I do not want to say, well, the company has a dividend rate of 6%, 5.65%. I might say that when they ask what the dividend rate is, but if they ask, what is the growth rate on my policy? I want to pull the internal rate of return because this isolates the true net growth rate after all fees, expenses, and everything that comes with the life insurance policy. Why this is important is because when we look at policy loans, this video is about using the money, we're going to have what if we take a policy loan? An interest rate, a loan interest rate. So that is a cost, and specifically what I want to look at is what is the cost to borrow, the loan interest rate, compared to the internal rate of return, so I can see the exact growth rate compared to the exact loan rate and see, am I ahead or am I behind? The yearly cash value growth column. This is the same as the internal rate of return, but in dollars. A nice way to look at it is, let's look at year one. You pay in $250, your cash value is $224 and change, which is a loss of what? A little bit over 10%, which comes out to $25,000 and change. If that cash value was exactly $225,000 and you paid in $250, well, $225 is exactly 10% of $250. So what that means is if this was $225, that annual IRR would be negative 10.00%. Again, assuming if we had round numbers in this particular case. But here we've got a little bit less than that, but hopefully you follow me there. You know what, why don't I do this real quick, because this would help me. If we cheat the system, 225, watch this. Look at that, negative 10%. But I don't want to do that. We want accurate values from the illustrations. So IRR, yearly cash value growth, is identical to the annual IRR, but in dollars. So that means if I look at year 4 to 5, I've got $700,000. I paid in $150. The cash value is now $874. What this means is I got my $150 back. If I put that just under my mattress and I had $700,000 in change and I added $150 to it, what would I have? I'd have $850, but I've got $874 and change. So what this represents is the fact that the cash value grew by 2.81%, and that 2.81% comes out to just about another $24,000. That's the yearly cash value growth. And then I've got the total gain, which you'll notice here, it's in the red for the first 3 years. And the reason why is look at the total payments column, and then look at your cash value. Your cash value is less than what you've paid into the policy. By year 4, you've paid in $700,000. You've got $700 and change, $988 to be precise. So the gain is $988. Where this is valuable, going back to the loan scenario that we're about to look at, is if I'm taking loans, I want to see how much I'm paying in loan interest on a yearly basis. That I can compare to the annual IRR and also the yearly cash value. And then I want to look at what's the total amount I paid in loan interest over the life of a loan. Whether I never pay it back, I make interest-only payments, if I pay it back over a long period of time or a short period of time, let me look at the total amount I paid in loan interest and then directly compare that with the gain that I have on cash value. Let's analyze, shall we? All right. So here, we've got a cash value collateral loan workbook. So these are not direct policy loans from the insurance company. A cash value collateral loan involves taking your policy, or in this case, the couple's two policies, to a bank and assigning the cash value to that bank as collateral. Cash value column, there's those other three columns, IRR, cash value, growth, and total gain. But then here, loan value, 95% of cash value. So if you have a cash value collateral loan, most lenders, not all, but most of them, will allow a line of credit, an LTV of 95%. LTV stands for loan to value. So whatever my cash value is, what's my maximum loan percentage? Most will offer 95%. Some go up to 100%. If you said, I don't want to deal with banks, I want to take direct policy loans from the insurance company. In most cases, you'll see between 95 and 100% LTV. Whatever your cash value is, you can access in policy loans somewhere between 95 and 100% with most companies and products. There's a couple of factors that impact that, but generally you'll see that range. So here, we're going to run it at 95%. And here we go. So we can plug in here in this loan column, whatever this available equity is, this LTV column, because you'll never see the cash value and the LTV match. For example, if we look at year 15, the end of the funding, total cash value is 2.574. The maximum loan, 2.445. That 2.445 is 95% of this figure. That's what that is, the 2.574. So when we plug in loans, let's look at this first. Annual IRR, and compare that with the interest rate. Actually, before we plug in loans, we can look at that. Do we ever see the internal rate of return hit 6%, which is what we're paying in loan interest in this example? No, we do not. So what that means is if we take maximum loans, if I take the maximum loan I can take every single year at 6%, I'm going to pay more in loan interest than what the policy will produce. Want to see an example of that? Let's start with that, more of a worst case scenario. So let's do it in year 6. If I take a $1 million loan, because that's my available equity, not much available equity left, $1 million at 6%, $60,000. Here in purple, it is assuming that we're paying the loan interest each year. Scroll our eyes to the left. What happens? I'm paying $60,000. The yearly cash value growth is $39,000 and change. That means my policy produced less in gains than what I paid in loan interest. How about the next year without any additional loans? So at 6%, I paid $60,000 in loan interest. The gains, however, $48,000 in change. Starting to catch up. Following year, what are the gains? $57,000. What I pay in loan interest? $60,000. Why is it catching up? Well, the reason why we took that $1 million loan, there's my loan balance. We are paying the loan interest each year while we are paying the premiums as well. Not everyone likes to do that. Some don't mind. But my point is here, $1 million is the loan balance. At 6%, there's the interest I'm going to pay. Here's my internal rate of return. It's less than 6%. However, it is occurring on the full cash value balance, while the 6% is only occurring on the outstanding loan balance of $1 million. So here, what will eventually happen is because I have a greater volume of money in cash value, bigger bucket, yes, it's a lower rate, but it's on more money. So it's going to catch up and overtake what I'm paying in loan interest. How I can make this work against me is by taking out more in loans. Take another $500,000 here. There we go, paying $90,000. Now, as time passes, things will get easier and easier for a policyholder. Typically, this is viewed as a long-term approach. And really, if I'm going to speak frankly on it, where this doesn't make the most sense or where it can hurt you from a strategy standpoint is in the early years. And the main reason why, without looking at numbers, is in the early years, cash value is less than what I've paid into the product. I've got a negative internal rate of return. For example, $250 went into the policy in the first year, and we've got about $225. It's a $25,000 hit, no matter how I slice it. So if I've got a negative internal rate of return, and I elect to borrow against the policy and pay loan interest in the early years, not only do I have that negative hit on my money, but I'm also paying loan interest. It's almost like I'm shooting myself in the foot in some respects. Now, every year after the first year, it gets better and better. So what that means is as the gains continue to pick up the pace, that makes the loan interest hurt more and more, and it continues to feel better and better, and it gets better and better. This is why a lot of people use it. But where that, oh, I didn't know that situation pops up, is typically where not enough awareness is being provided around the fact that the loan interest, particularly in the early years, is outpacing the gains on the policy. That's what we want to make sure we have a crystal clear understanding on. So let's look at paying this back. Actually, one other thing here, if you don't want to pay the loan interest, so we can get a sense of what that looks like. There we go. And this just lets the loan interest compound over time. But let's repay it. So why don't we do something like this? Let's take a loan earlier, $500,000 in year 3, and then let's pay it back. You know what? Why don't we pay interest only? And we'll do that until year 10. The reason why, from a strategy standpoint, is we're aggressively funding it the first 10 years. So beginning year 11, let's take that additional $100K we were funding the policy with and repay the loan balance. We can do it much earlier, but this is just cool in my opinion to be strategic like this. All right, beautiful. And now we can analyze everything. And everyone's situation is unique, but this allows us to see their situation and exactly what it looks like. Perhaps it's similar to your situation. Number 1, loan coming out in year 3 of $500,000. That's 6%. There's the $30,000 in loan interest due. And in purple assumes we are paying it. So that's money going out of our pocket to the bank or insurance company if it's a direct loan. And here, we're also funding the $140. So if this is you, your true net out of pocket is the $150 plus the $30, so $180,000. That's too high. What some people will do is reduce their funding, so pay in only $120 in order to be able to at least cover the loan interest. And that is something we can analyze to see what's the short-term and long-term benefit there. But as we look at this, $30,000 per year being paid in loan interest. Let's analyze the actual cash going out compared to the cash value growth. If we look at it year by year, what do we see? Because in purple to the left, we've got the yearly cash value growth, which I prefer over the rate because I can see dollars that I'm receiving compared to dollars I'm spending. And in this particular example, by year 6, the gains are exceeding the interest cost. And we're assuming just a $500,000 loan, and we're not taking additional loans, which a lot of times people will take additional loans. So we want to look at it year by year. Also, they're also paying it back while they're taking loans. But here, $30K per year. Before we look at the payback, look at the total interest payments. By the 10th year, you've paid how much? $210,000 in loan interest. Ouch! However, your total gains are what? $267,000. Okay, so the gains on the policy have outpaced the loan interest. And if we've been using this for pure business expenses, it is possible that I may have been able to deduct some of the loan interest. I want to make sure I'm working with a CPA for a number of reasons. We've got some other videos that speak to that. But to get back on track here, when we repay it, what do we see? The total loan interest out of pocket, $300,000. Total gains, $724,000. And we can look at different models and such here. We just looked at a $500,000 loan. But again, this allows the numbers to speak to us to know, is it in my best interest? Looking at different funding models. Here we've got the example with the $100K per year for the husband and $50K per year for 15 years for the wife. Maybe we look at flipping it. We plug in different funding models. That's the kind of stuff we can do. So when we're working with someone, we want to make sure we provide the options they want to see. I want to keep it simple. We'll provide the best options, our recommendation after we've discussed flexibility features, company selection, a lot of those important aspects. And then once we begin to narrow things down, we can look at the loan analysis, assuming the individual we're working with wants to look at the loan analysis. I have worked with individuals that just say, tell me what to do. I'm like, all right, well, here would be my recommendation, and here's the data to support that recommendation. In any event, I hope you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.